Hello, and welcome to another episode of the Market Snapshot series. My name is Rufas Kamau, Markets Analyst at FX Pesa. So, first of all, I'd like to begin with an apology. We had some issues with the YouTube setup this morning. So, we normally hold this session at 11 a.m. But now we've had to push it 2 hours. But nevertheless, we are going to deliver and have some good content today. So we know that there is a lot of stuff that we were expecting to be happening in the markets this week. But one critical event has happened in the US markets, and now it remains a priority. And it's very important that we understand what we're expecting, and then trading through the week, you'll know exactly what to do and what to focus your energy on. So as we proceed, if you have any questions or comment, feel free to type that in the live comment section, and I will be responding to that right away. So hello, Martin and Charles, and welcome to the session. So we will be looking to dissect the SVB saga. So hello, Trapscade, hello, Anthony. Thank you, guys. Thank you for joining in. So we know that last week, 3 US banks collapsed. And that was a big news in the market. So we'll be looking to understand what exactly happened and what we're expecting to be happening in the markets. So let me try and share these. I have some notes, though incomplete. Hopefully we'll get to understand what is currently happening. So the 3 US banks that failed last week was one, Silvergate, which is a much smaller bank. We had Signature Bank, and the biggest one of them is Silicon Valley Bank, or SVB. So amid the larger market sell-off sparked by SVB, we also had PacWest, we had Western Alliance, First Republic Bank, and Charles Schwab affected. So what happened with these other banks, besides the top three, is that their shares tumbled by quite a huge percentage, with PacWest dropping 30% on Friday, Western Alliance 45%, First Republic Bank by 19%, whereas Charles Schwab went down 11%. So this is a big worry. It's a new event that is influencing the markets. Everyone is trying to take flight to safety. The market is learning every minute about the parties that are affected by the closure of the banks. And at the same time, investors are trying to understand where the opportunities lie and where the risk lies, so that you avoid all the risk and go for a safe haven, or if there is a good position, then go for it. So about 94% of deposits with a Signature Bank are not FDIC insured. So this is the Federal Deposit Insurance Corporation that basically insures the money that you keep at your commercial bank. So the limit is 250,000, but as you can see, about 95% was not insured, meaning that in the event that the bank collapses, then the depositors get nothing. And this is about 94% of the depositors. So following a huge bank run, the bank could not honor its obligation to depositors, which led to the collapse. So the Fed, FDIC, the US Treasury all gathered together in a meeting by regulators and the leadership in the US, and they together devised an emergency plan to honor all current deposit withdrawals on Monday, and that's today. So this morning, remember, for the US, they're just getting into their morning this afternoon. They will be looking to wake up and access their deposits from the failed bank. And this is from the emergency response that was implemented over the weekend. So as you can see, here's a Twitter screenshot from the US President Biden. And he mentioned that, and I quote, "At my direction, Secretary Yellen and the National Economic Council Director worked with banking regulators to address problems at Silicon Valley Bank and Signature Bank. I'm pleased they reached a solution that protects workers, small businesses, taxpayers, and our financial system." So this was in response to the headline from the New York Times, which said, and I quote again, "Breaking news, federal officials closed a second bank and said it would bail out all depositors in the wake of Silicon Valley Bank's collapse. So there is a lot that is happening. And first, let's describe what a bank run is. So a bank run happens when a lot of customers withdraw their funds from the bank at the same time. And this is mainly due to concerns about the bank's solvency. So if people are afraid that the bank doesn't have the money that the depositors kept with the bank, then they rush to withdraw that money. And when that happens, if the bank doesn't have sufficient funds to honor the withdrawals, then it's declared insolvent. So bank runs can drain a bank's reserves and lead to its failure. And this has happened time and time over again in historical periods. So the FDIC was created to prevent bank runs. So the trigger moment was from a very popular billionaire called Peter Thiel. He's currently the co-founder of a very popular AI company. So he's also a very renowned investor. And in this case, he has what we describe as the Founders Fund, which is basically an investment firm that majorly focuses on young or new ventures. So they do a lot of angel investing in those companies, and they control quite a huge amount. So Peter Thiel's Founders Fund had no money with Silicon Valley Bank as of Thursday morning as the bank descended into chaos. According to a person familiar with the matter, Founders Fund withdrew millions of from SVB, say the person, who has not to be identified discussing private information. So it joined other venture funds that took dramatic steps to limit exposure to the now failed financial institution. So when the Founders Fund realized that there is a lot of weaknesses in that bank, or in simple terms, them being the clients, the bank, they were suspicious that there could be concerns about the bank's solvency. So they withdrew their funds and also asked their investors to withdraw any funds that they hold with the bank. So the bank leaders also liquidated their shares last week before the collapse. So there's some allegations that there was insider trading where the guys working at the bank realized that there was something bad happening with the bank, and they proceeded by selling their shares before announcing the information to the public. So the CEO sold about 11% of his stock holdings. The counsel, Michael Saga, sold 19%. Daniel Beck sold 32%, who is the CFO, and the CMO, Michelle Draper, sold 25% of their stock holdings. So the run began on Thursday after a powerful Silicon Valley VC, and this is again Peter Thiel's Founders Fund, had begun advising its portfolio companies to withdraw their money from SVB, sources told Fast Company. So other VCs soon caught the wind of the advisory and began advising their own portfolio companies to withdraw funds from SVB, the people said. So as the withdrawals accelerated, the bank began taking steps to stem the tide and preserve its solvency. So just like George Bailey did in 1946 classic, It's a Wonderful Life. So let's try to identify what happened to SVB. And this is a direct quote from the Guardian newspaper. So as the preferred bank for the tech sector, SVB's financial services were in hot demand throughout the pandemic years. So remember in 2020, 2021, and some part of 2022, there was a very strong bull run. We saw a lot of crypto companies doing well, as well as other tech companies. And a lot of investors who had made a lot of money in the bull run sought to expand their investments. And in this case, they went for venture capital to invest in smaller businesses. So they would use the SVB bank as their way. And this means that a lot of deposits came from such venture capitalists, and a lot of billions were flowing to this bank. So the initial market shock of COVID-19 in early 2020 quickly gave way to a golden period for startups and established tech companies as consumers spent big on gadgets as well as digital services. So many tech companies used SVB to hold the cash that they used for payroll and other business expenses, leading to an influx of deposits. So if you are a young business, a tech company, could be a crypto product, whenever you get venture investments, you would most probably keep your money with the SVB. So where on one side, investors were putting money in through SVB, also the recipients of the cash would bank with the same bank. So the seeds of its demise were sown when it invested heavily in long-dated US government bonds, including those backed by mortgages. These were, for all intents and purposes, as safe as houses or real estate. So when the bank got a very large number of deposits, as all banks do, they invest a proportion of that money while keeping afloat to honor client withdrawals. So they bought US 10-year bonds that were yielding a very small return of about 1.5%. So this was not the problem. The problem happened from March last year when the Fed started hiking interest rates. So with higher interest rates, we all know that investors tend to go for short-term treasuries. So the short-term US treasuries include the two-year bond, which was yielding up to 5%. And it is deemed as one of the safest investment because most investors see or perceive the US central bank as the most stable in the world, since it has never defaulted on its debts. So in this case, it's deemed a very safe investment, and they made the right decision by investing there. However, when the Fed started raising interest rates aggressively from March last year, from between 0 and 0.25% to the current level of 4.75%, then the bond market became less interested in the long year term that were yielding smaller returns and more interested with the shorter term bonds that were having bigger returns. So nobody is interested in buying a 10-year bond that is yielding 1.5%. So in that case, the secondary market for such a bond tends to go down, whereas the primary market for short-term bonds such as the two-year treasuries become very interesting and attractive to investors. So in this case, a lot of banks that were holding the 10-year bonds at 1.5%, they can't sell those bonds in the open market without making a significant loss. So now that we understand that, we keep going. So bonds have an inverse relationship with interest rates. So when rates rise, bond prices fall. So when the Federal Reserve started hiking interest rates rapidly to combat inflation, SVB's bond portfolio started to lose significant value. So if SVB were able to hold those bonds for a number of years until they mature, then they would receive its capital back, plus, of course, the 1.5% yield. However, as economic conditions soured over the last year, with tech companies particularly affected, many of the banks customers started drawing on their deposits. So we know that we were in a bear market last year. A majority of the US companies were going down. So having financial difficulties and also including inflation. So a lot of these companies started withdrawing their deposits significantly. And in order for the bank to honor these deposits, it had to sell some of its bonds, and in this case, selling at a loss, in order to receive value and use this value to repay or to honor customer deposits. So the SVB bank did not have enough cash on hand, so it started selling some of its bonds at steep losses, spooking investors as well as customers. So in just 48 hours, between the time the bank disclosed that it had sold assets and its collapse. So when the bank went for the first time liquidation of its bonds at a loss, once it disclosed that information, then people became suspicious that the bank doesn't have sufficient capital to honor withdrawals, and that basically triggered the bank run. So given the banks only keep a portion of their assets as cash, they are susceptible to a rush of demand from customers. So while SVB's problem stemmed from early investment decisions, the run was triggered on 8th March when it announced a 1.75 billion capital raising. it told investors that it needed to plug a hole caused by the sale of its loss-making bond portfolio. So instead of selling more of the bonds that it held with the US government, SVB sought an alternative route. So you have two options. You can either sell your bonds at a loss and use that cash to honor withdrawals, or you make an emergency capital raise from the market. So in this case, they were looking to get 1.75 billion, and they would use this money to basically repay deposits while they hold onto their bonds, hoping for recovery. So suddenly, everyone became alarmed that the bank was short of capital, says Fariboz Boshirian, who is the professor at the UNSW and director at the Institute of Global Finance. So customers were now aware of the deep financial problems at SVB and started withdrawing money en masse. So unlike a retail bank that caters for business and households, SVB's clients tended to have much larger accounts, and this meant that the bank run was swift and very fast. So 2 days after it announced it would raise capital, the US 200 billion company collapsed, marking the largest bank failure in the US since the global financial crisis of 2007-2008, when we saw the Lehman Brothers collapse. So in response, well, the US is bailing out the depositors. So remember we mentioned that a large portion of the depositors were not FDIC insured. The US seeks to protect its customers, people who are innocent, who had just deposited their money with the bank. So if you had deposited your money with the bank, naturally, the limit would be $250,000. So any amount above that would not be insured, meaning that the FDIC would give you 250K, and any additional deposit that you had above that would have to wait until the bank is liquidated, and you'll probably get cents on a dollar because it was a loss-making venture. So instead of such happening, the president announced that every depositor will get their cash as soon as Monday, which is today. So the depositors are now secured. However, the guys who are getting the short end of the stick includes the other bond holders. We know that the bonds are now going down as a result of such. So when you're selling your bonds in the open market, you're basically increasing supply and pushing prices lower. So if you are, let's say, an individual bond holder, then you're on the receiving short end of the stick, mainly because your bonds have just gone down as a result of the bank's mismanagement of its financial position. So the other guys who are losing out big time are the stockholders of these banks. So as I mentioned earlier on, we know that the bank had gone down about 69%, that is SVB, but eventually it went down, and I predict that somehow, though the stock was halted from trading, it's probably trading at zero or something close to that. So as you can see, other banks that had exposure to Silvergate, Silicon Valley Bank, and Signature have also taken a very big hit in their stock valuations, with some of them dropping 30%, 45%, and 19% and 11%. And we'll be expecting some further sell-off to be happening later today. So now that we know that there is no bailout, late on Sunday, US agencies extended a guarantee to cover all deposits at the bank, as well as for customers at a second smaller institution, which is a Signature Bank, that collapsed over the weekend. It means that customers at SVB will be able to access all their money on Monday morning. Shareholders in the bank and some unsecured creditors aren't protected by the guarantees. So the other question is, how does this affect interest rates? So we know that central banks around the world have been raising interest rates over the past year to tame high inflation, with the US moving from near zero to more than 4.5% at a rapid pace. So with this aggressive rate hike, most forecasters expect rates to go higher in the US, the UK, and Australia before stabilizing. So just last week on this very session, we were talking about a potential 50 basis point hike by the Fed on its next meeting on March 22nd, which is next week. So The appetite to keep raising rates will now have to be tested since there's new factors in play, especially if central banks become concerned that SVB's problems are indicative of a broader weakness in corporate balance sheets caused by raising rates. So when you raise interest rates, short-term debt becomes attractive, longer-term debt becomes less attractive. Then if the Fed went ahead next week and implemented another 50 basis point hike, it means that other banks within the US would have to liquidate their longer-term debt, that's their bonds, in order for them to honor withdrawals. And any bank run that would happen on any financial institution in the US would most probably face a collapse. And this is deemed as systemic, as it would cause ripples across the entire financial system in the US. And not just in the US, could also spread globally, since there are other foreign investors who have direct exposure with US banks. So this has become the biggest news of the week, and we will be expecting everything to be surrounding this in the markets today. So we know that HSBC Bank has responded by buying the SVB branch that was located in the UK. And funny enough, bought this bank for just £1. Not 1 million, not 100, not 10, £1. So the loss-making institution after the bank run didn't have a lot of options. So in order to protect the clients in the UK, it basically sold off the UK branch at a valuation of £1. So we will be getting more developments on the same in the day. So what took place on Friday was an old-fashioned bank run. Customers yanked 42 billion from Silicon Valley Bank on Thursday. So you can imagine you wake up one day and your clients are withdrawing not 1 billion, not 2, but $42 billion. So if you don't have the cash, then you are forced into insolvency, which left the bank with 1 billion in negative cash balance, meaning that clients basically withdrew all the $41 billion that the bank was holding and an additional $1 billion. So the company said in a regulatory filing, so in other words, the bank owed more to customers that it had on hand. So SVB and federal regulators scrambled but couldn't raise enough capital to make up the difference, and the bank was declared insolvent on Friday. So when there's more depositors claiming their money than the money you hold, then you are by definition a bankrupt institution. So the Federal Deposit Insurance Corporation took control of the bank and said it would pay customers the insured deposits on Monday, but there is a catch. The FDIC covers just $250,000 in customer deposits, and this means that the Fed will have to chip in the extra money. So as of end of last year, Silicon Valley Bank said it had 151.5 billion in uninsured deposits, 107.6 billion of which was held by American customers. And of course, the 250K limit was lifted. So now that we understand all that, let's look at how the markets are responding. So we will start with one very popular asset, and that's the dollar index. So unfortunately, my dollar index is not loading. So this is how the markets performed Friday. So the dollar index had gained quite well over the week, then made a sudden drop towards the end of the week. Today, made a very strong and sudden drop before making a recovery, so indicating some weakness in the dollar. So main reason we are seeing the weakness in the dollar is because once that limit is lifted of 250K, then it basically means that the US Treasury will have to chip in the extra amount, and it doesn't have this amount set somewhere beside. So investors are speculating that the US will be printing more cash to chip in and protect investors. However, it's not a significant amount compared to the $6 trillion that were printed during the pandemic. So whereas there will be more money being printed by the Fed, it's not as big as the amount that was moving the markets during the pandemic. So whereas there could be printing leading to a weakness in the dollar, it's not that significant, and that might explain why we are seeing a recovery here. So as of last week, the dollar was pretty strong, strengthening against the Australian dollar. So after this jump here, you can already see the market normalizing. So gold made a very strong rally on Friday, and today it's moving higher. So we know in terms of uncertainty, then the natural reaction is to buy more gold. So a lot of investors have been buying gold to hedge until they know a way forward as a result of what was happening last week. So today might end up to be a very bullish day for gold. So be on the lookout for this. So another trigger movement is that today at 8 a.m., that is the US time, we will be expecting a speech from US President Biden, and he will be looking to explain what happened, what the government is doing, and how it's looking to protect the consumers, as well as restore confidence in the US financial system. So that speech is the most anticipated data point for today, and it's expected to move the markets a lot. So besides this, if you look at equities, we are seeing a big sell-off besides the early morning move upwards. So the move upwards was that was from the expectation that the Fed will stop hiking interest rates and now start considering cutting interest rates to support the failing banks. But now we are seeing resumed panic. So US 500 or the S&P 500 dropping back down. The Dow Jones index are selling back down, as well as the NASDAQ 100 selling back downwards. So we will be expecting some more volatility today, whereas oil had made a recovery on Friday. You can see the sharp drop happening today. So UK 100 or the FTSE 100 making a very sharp drop. So this is one asset we've been saying that it's extremely overvalued. So managed to trade sideways for a while before breaking here on Thursday. Then on Friday, some further sell-off, and then today on Monday, we are seeing some further downside. So even from the daily chart, you can see the fall back to the lower trend line here, which was acting as the upper trend line previously. So China, the Chinese currency strengthened very well against the dollar, despite the very strong recovery in the last couple of hours. But now we'll be looking at more impacts arising from the recent developments. So checking on the comment section, now that everyone understands the SVB saga, is it possible to have a high interest rates and high inflation market? Yes, it's very possible. It's what we have been experiencing. Right now, as we speak, the US inflation is 6.4%, which is very high. And interest rates are very high at 4.75%. The same case in Kenya, inflation rate 9.2%, interest rates at 8.75%. So hello, Charity Genius, welcome to the session. Hello, Anthony. Hello, Chris. Thank you, guys. So the NFP results are quite a mix of data. There was a big number printed in February. So it was restoring confidence that the US economy is very strong. And also some mixed data leading to an opposite reaction. So remember, today in the afternoon, in the evening at 6 p.m., we will be holding a Twitter space on the same, especially after President Biden's speech. So we'll be looking to dissect the issue further. So we'll be investing more analysts in the space. We look at what has happened with SVB and try to understand how it eventually affects the markets. So going forward, if you have no idea what's happening around the world, it doesn't make sense to participate in the market. But now, if you have an understanding of what happened and what you're expecting, then it might make sense to take advantage of the increased volatility in the markets. So my personal expectation is on one hand, there could be a consideration to hold rates steady rather than going for a rate hike as the Fed assesses the risks to the banks, because another rate hike would add more pressure to the banks and lead to more failures. So there is a good opportunity that the Fed will stop hiking interest rates and now start considering cutting interest rates, and that would mark the bottom of the bear market in equities. However, if this doesn't happen and the president and the regulators decide that if anyone took bad risks in the market, then they carry their own burden, we are only protecting the consumers, then in that case, we would have a very strong dollar and weak equities. So a collapse could eventually happen if the Fed continues hiking interest rates, especially if they go for a 50 basis point hike on the next meeting, and that will be on the 22nd of this month, next week. So thank you very much, guys. Thank you for your time and participation in the in this webinar. I hope to see you on the space, Twitter space in the evening. So just go to Twitter, search FXPesa, and then set a reminder for the Twitter space that has been set there. So I hope to see you guys on the next session. Tomorrow we'll be having another session. It will be at 11 a.m. So be prepared for more news as well as updates on what's happening.